Good morning, everyone. Welcome to this update for global stocks and commodities for the 27th of January. I've titled this week a contrarian stream market because really what's evolved over the last few months has been very much that. Whenever consensus on pretty much any point at all reaches a bit of an extreme and everyone agrees that it's logical that XYZ should happen, then that tends to be a turning point in that particular market. And it's just happening over and over again. And, it sort of begs the question whether markets are being manipulated to a degree by algorithms. I'm sure they are, pushing markets heavily in one direction, making a profit that way, and then abruptly turning the market around the other way and catching people out. And so you've really got to be more on your toes these days, and certainly your activity should be focused on the extremes in both directions. So more on that as we go through. So look, it's a bit early to draw conclusions on whether this rally is going to continue or whether we will get some sort of retest. But as I said, the table pounding, very emphatic crowd is just being wrong-footed at every turn of the market. And if you're going along by trying to read the news or trying to trade according to what seems logical and follows the fundamentals, then you're going to be finding it pretty hard going at the moment. So forget the predictions. All that matters is the market action. And if you trade from the extremes, buy into extreme sell-offs and take some profit on the rebound, then you'll do pretty well. Also, too, I want to highlight in this edition that the gold market is just gradually, steadily showing more positive long-term and even short-term signs. And we saw quite a big surge in the gold price on Friday night. Not too sure what that's about, but it was certainly a very positive session. And Portfolio Analyst last week, I reviewed the Australian growth microcaps that I've been following for the last year or two. And there's certainly been some interesting action there. And I also recommended a very attractively priced and a stock that's in really good fundamental shape, a global healthcare mega cap stock, well over $100 billion market capitalisation, and yet it offers, I think, a very attractive entry point at the moment. So that was Portfolio Analyst last week. American stocks, the S&P index actually ended down 5 points on the week. But the US economy and the consumer are still strong enough. Now, there are issues in America, but nothing like in Europe, which is almost stagnant now, the European economy. And of course, China, Japan, most of the rest of the world is struggling now. But the US economic picture is certainly looking reasonably okay. Now, I know they've got it's just a massive debt problem that's going to come and bite them one day, but that could be 10 years away. The corporate debt market is the one that bothers me the most, and that's one that I'm watching very closely. But at the moment, that there's no real signs of stress. There's a lot of predictions. There's a lot of finger pointing about all the corporate debt that needs to be rolled over in the next 2 years. And how difficult that's going to be for a lot of companies to do, and all that's true, but it doesn't necessarily mean that there's going to be a significant problem. So, things aren't too bad in the States, and earnings season is underway. And we've seen 6 of the 11 sectors of the US market reporting double-digit earnings growth, which is pretty impressive. So that's exceeding expectations. And the forward PE for the market is only 15.5, which is below the last 5-year average PE ratio, and only slightly above the 10 years. So again, as I keep repeating, I just don't understand these people that want to tell you that the US stock market is at its most expensive valuation in history, because clearly the numbers that I look at don't certainly support that view. Now, the rally that we've seen in the S&P has now moved into a very strong resistance zone. It's been a very impressive rally, but we're certainly at a point now where you would expect the market to pause. And we've got a huge week coming up on earnings. 1/4 of the S&P 500 companies report this week alone, which is, I can't remember a week with that many companies reporting. So potentially there's going to be quite a lot of market movement. US dollar ended up a bit lower on the week, and the 10-year Treasury yield eased off as well, back down to 2.72, but that's quite a long way from the breakout we saw a few months ago above 3%. All right, let's take a look at some of the market action, and we'll start with the S&P. I won't start with the energy sector. So this is a chart that I've been showing for the last few weeks, and this is the huge plunge. Obviously, the breakdown that occurred on December 17, and then we got that massive sell-off into Christmas, the most significant sell-off that we'd seen since 1929, and now, quite unexpectedly, there has been a massive rally. Now, given that this breakdown here was really manufactured by lack of liquidity and the computer algorithms just amplifying everything, it was reasonable to get this bounce to here. So if you argued that this breakdown really was a bit manufactured and shouldn't ever have occurred, then the market rebounding to about here, about 25.30, would have been normal. But it had done that by the 4th of January, and it's just kept going on with it. So 3 more weeks later, and we're up at getting close towards 2,700. So there's no question that this V-shaped rally was quite unexpected, and has gone a lot further than everybody thought it would. We managed to get through a couple of resistance points here, but we're now into a zone of resistance, and I think it's inevitable. Markets just don't go in straight lines, and there's too many trigger points out there to be concerned about. So I think it's reasonable to assume that inevitably there will be a pullback by definition. So it's just a matter of where to. Now, this green box here was where I had expected to see some sort of retest. I think given the market action and the outlook and the US earnings season, I think I could probably move this box up now to look something like this. I think that might be a more likely area of retracement. In fact, I doubt we're going to go much below 50%, so I think I'll probably target that area there. But look, that's just really short-term observation of the market. It doesn't really matter within the time frame that most people are transacting in. But we've got to expect some sort of pullback. And my point is that you really want to be buying on market weakness. You don't want to be buying into this rally and predictions that the rally is going to continue. So be clear on what it is you want to buy. Wait for the pullbacks, buy into those, take some partial profit on the rally, and that's really the most sensible way and the most productive way to trade this market. Now, small caps have also been rebounding quite nicely. This is the Russell 2000, and it's come back up quite nicely as well. US dollar slightly lower for the week as the prospect of rate rises from the Fed just get a little bit less and less as each week goes by. So the US dollar now starting to come off a little, and that's seen the Australian dollar poke up towards 72 cents again, but we're still really stuck in this range between 70 and 73 cents, and slightly towards the upper portion of that band. So there was the Australian dollar, finished up at 71.8. and our index was up by 27 points, or about 0.5% for the week. And as I have been indicating now for some time, so nothing's changed here. My view is very much that we've got some undervalued growth stocks in the top 200, which I think are terrific long-term buys. Not sure, exactly when they'll rebound, but I'm pretty confident that we've seen the lows, and the upside risk far outweighs any downside risk. And also, of course, the growth microcaps that have suffered from liquidity issues in the last couple of months, but the businesses themselves still progress very nicely. And at some point, there will be quite a good re-rating in the market. And I covered this last week in depth on the Australian market and in Portfolio Analyst. And I used an example of Altium and just showed the stair-step sort of pattern that these stocks go through, where they might go sideways for 12 months and then they go up by 100% or 150% over a period of time, maybe 6 months or so, and then they go sideways for another 12 months, and that's the way that they tend to go. And I think many of these growth microcaps will do the same thing. And also, I think there's certainly a case now for expanding the exposure to Australian gold producers a little bit more. I think there is, so they're a bit overboard at the moment, but I think adding to some of the Australian gold producers on weakness is probably not a bad thing to do either. So let's just take a quick look at the Australian index. So it's been pretty positive after we got down to almost 5,400 points just before Christmas, and now we're back to 5,900 points. So nearly a 500-point rally in the Australian market. Precious metals now. Gold spiked $23 on Friday night to finish at 1304. I can't put a label on specifically why. It just seemed the market really started to support gold. Sure, the US dollar moved down. That helped a little bit, but that was only about contributed to about 1/4 to 1/3 of the price rise. So the rest of it was just a renewed enthusiasm for buying gold. And a new big picture uptrend does seem underway. Certainly we've got a short-term uptrend, but a new big picture uptrend, which I believe started in 2016 with that initial surge that we saw, where we had a tremendous rally for 6 months, probably the strongest short-term rally in history. And I think that's when a new uptrend started. It's taking its time to really get established, but certainly the sign's looking much better for precious metals now. And I'm going to cover this in more depth in Portfolio Analyst this week. Precious metal stocks, global stocks are working their way higher. So let's jump in and take a look at the charts on gold. So we'll start first of all with the daily, and you can see that we had previously moved up. We crossed the 200-day moving average in just before Christmas. That's the red line, and so that's always gives always a technical boost to stock prices when it's above the 200-day, particularly when it's been below it for such a period of time. And we then formed a little compression triangle leading into the start of last week, and something had to give. The market gave to the downside just to trick everybody. We were down for a couple of days, and then this big surge on Friday night that took it back up above 1300. Now you can see quite clearly that we've got an uptrend. There's no question that uptrend started in August of last year. So we've got just a series of higher highs and higher lows. And as I said, we're above the 200-day moving average, so that certainly helps. If we expand out, though, and we look at the bigger picture, and this is what I'm all going to cover in detail this week in Portfolio Analyst. You can see here the big picture for gold. We peaked out at just over 1900. We did a move all the way down almost exactly to this prior major peak from 2008. Market found some stability there. We then bounced in the first half of 2016 and stopped at exactly 2 points. The first one was the 38.2% retracement of this whole correction. And secondly, it also corresponded with the downtrend line that had been established from these 2 points up here. So no real coincidence there. The gold price is technically behaving very well at a big picture level. So we then went into a consolidation, but you'll notice that we're still forming the significant lows are higher. So this one is higher, this one is higher. We haven't yet broken out and created new higher highs. So that occurs roughly through here, around about the somewhere between 1370 and 1400. So we do need to get above that area. But this is all part of a big picture basing pattern. And I think it's quite likely now that we're going to see several years of the gold price perhaps working its way back towards this $1,900 level and perhaps even taking it out. So I think that has some validity to it. But that's a very big picture indication. It's really the shorter term, and at the moment, the shorter term is up, strongly up. We're probably going to run into resistance around 1360, and then, of course, stronger resistance around 1400. But gold stocks are on the move, very much more so in Australia. GDX responding a little bit, but it's still pretty muted. The Australian gold stocks have done very well because the Australian gold price, the Australian dollar gold price, has been so much higher. It's over $1,800 an ounce now. So that has certainly helped. But also the Australian gold producers as a business have done far better than the North American ones. Those mega cap gold stocks over the last decade have made a lot of fundamental mistakes. They acquired other companies at the peak in the market. They took on too much debt, and they've curtailed their exploration efforts at the wrong time. They've really made a bit of a hash of it. Whereas the Australian gold producers, led by particularly stocks like Northern Star, Regis Resources, Saracen Resources, are extremely well managed and have done extremely well through this period. But also helped by our currency effect as well. So certainly some good opportunities in the Australian gold market. They're overbought in the short term, so you don't want to be buying into them just now, but they are in strong uptrend, and the fundamentals around them look pretty good. And if gold does continue to work its way higher, then it just gets better and better for the Australian gold producers. But as always, any significant changes you should make to your portfolio should always be in moderation. Don't ever go all in on a particular sector because things can always change. Commodities, copper slipped a little bit. Crude oil also back just 10 cents or so. Energy stocks rose, but they're still lagging the oil price, which I don't really like to see because it's just not, I prefer to see the commodity stocks leading the actual commodities themselves. That's generally a stronger indication. So not getting too excited about the energy market at this point in time. Let's just take a quick look at the XLE. So this is a weekly chart. We didn't quite get down to the 2016 lows, and we're getting a V-shaped recovery here, but it's just not really quite as robust as I would have liked to have seen. So yes, some more positive signs there, but still a little bit of caution. There's the spot copper chart. and not a lot of change in the copper warehouse levels. There's crude oil finishing at 53.69. So to wrap it all up, a retest of the December lows in the US indices is inevitable by definition, because markets don't just go in one direction. They do go up and then you get some sort of partial pullback. So I think that's inevitable. The nature of it, this rally, suggests that the duration of that retest, that that little down move, and the depth of that retest is now getting shorter and shorter. The longer this rally goes and the higher it goes is just displaying the buying depth that's in the market. And what we're seeing too is that the market is being, if you look on an intraday chart, the market is being quite heavily bought in the last hour. So we've really flipped over throughout the period from October to December. We saw some increased selling in the last hour of the market action, but now we're seeing significantly higher buying. So the market is being taken very confidently into the close. So this all sort of suggests that the retest is just going to be milder and milder. It's pretty obvious that you need some sort of contrarian way of thinking to survive and prosper in this market. And as I said last week, you need to be really clear about what part of the market you're targeting, the sort of stocks that you're after, and you need to buy when people are panicking, and then you need to sell when things start to look better, take some profit. And if you're not doing that, you're going to find this market very, very hard going. Portfolio Analyst this week, I've got an emerging and stock in Australia in technology that I think is going to be a very significant winner. It's one that I'm extremely keen on. And I'm also going to be looking at some gold market opportunities in the Australian market as well. So if you're not a member of Portfolio Analyst and you haven't taken the trial, then there is a $1 trial for 2 weeks that's available. There's also a lot of education that I pack into that service as well, so you can try all that out for a couple of weeks and see what you think. There's my contact details for those that aren't members, and I'll be back with you next weekend. Cheers.